Before we get started, I just want to make a reminder to everybody that the information discussed today is not to be interpreted or construed as investment advice. Everyone's financial situation, goals, and objectives are different. Please consult investment advice.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin. Hey, there's a bubble. Welcome back to the Loonie Hour, episode 40. As always, joined by the three amigos. We got Keith Dicker of IceCap Asset Management, and we got Rich Diaz, Tom Brady of Macro with Acorn Macro Consulting. Welcome back to the show, gentlemen. What's going on, Rich?
Uh-oh.
Yeah, crude oil t-shirt on today.
Yes. If you guys want to support me at Acorn Macro Consulting, on my website, I sell very cool t-shirts. This one's crude oil is super useful, which it is. And we'll talk a little bit why that's important for Italy and the rest of Europe later. But no, everything's fine. I've got to pay the piper today, which I'm a little bit nervous about. I took my insulin shot before I came to work today. So
a couple Twinkies.
I guess I'm ready to go.
Here.
I'm not going to eat them both at the same time because I think I'll get sick, but I guess we just start, right? Here we go. There's my Twinkie. This one's chocolate this time.
Ooh.
So you make, and there you go.
That sounds dangerous.
Steve, I think you should explain why we're out eating Twinkies today. Maybe somebody
Keith already ate his box. Yeah, we obviously had the Bank of Canada update. Last episode we had a wager. So it was Keith and I. We had 75 basis points as the prediction, and Rich had the 50. So Rich is gonna down two Twinkies here because he missed it by 50 beeps. And Keith and I are along for the ride here as well. So we'll be devouring those throughout the show. But yeah, obviously a pretty big shock here from the Bank of Canada. I think, markets were pricing in 75 basis points. I don't think there was very high odds of 100 basis points. And so it was definitely a bit of a surprise, the largest single rate hike from the BOC since 1998. I think what's really the most surprising thing is I know everyone kind of you guys were not calling for a whole lot of rate increases, but I don't know, show me a person that had the Bank of Canada going from 0 to neutral in 4 months. They went from basically 0.25 to 2.5 in 4 months. I think that's, correct me if I'm wrong, is that not the fastest pace of increase? I mean, it's the fastest pace to get to neutral, right? And for those that are listening that maybe aren't sure, neutral is what the Bank of Canada basically determines as the rate which is not stimulative and it's not tightening. It's their neutral rate. So that's kind of the rate where they typically want to be. So Keith, I don't know if you have any initial commentary on sort of your views from a financial market perspective of the move from the BOC here.
Yeah, that was it. It was absolutely shocking yesterday. It hasn't happened before that they have. Well, back in '98 they did it, but that's for a different reason. That was done to protect the currency. That's basically what it's done. What's happening today? They're doing it to try to cause inflation to come down. We can debate whether raising rates will do that directly or not. We will come back to that. But, very quickly, though, when I saw 100 basis points on my screen yesterday, I went, holy smokes, that's a lot. And I think if you had everyone across the industry yesterday who was following the Bank of Canada, everyone would have been like, holy smokes. Nobody was expecting it. And it's my initial thought as soon as I saw it, I said, hey, I think they're just pulling forward one of their quarter point moves. And I think that was really what was communicated during the presser afterwards. But as of right now, the market is pricing in another 75 basis points increase for the next meeting, which is September the 7th. So we get August off. So now we're going to have almost 8 weeks probably coming up here with no action from the Bank of Canada. Because they deserve, they've been working hard, guys. So they get August off, go up to Muskoka, I guess, maybe fly out to Kitsilano and hang out with everyone's favorite realtor out that way. But
Else if Macklem a discounted house.
yeah. But one thing I think may happen, I think if we go into September with no increase in stress around the world, or that's affecting Canada, they will continue with more rate hikes. If stress does increase to the point where it's getting really shaky out there, I think they're going to, that could be the last month where they're hike, or October will be the last month when they're hike. So like I'm now going to that camp. Like they're almost done, and it's just going to take, something to trigger them to say, okay, we're done. And I'm sure they're getting a lot of phone calls today. I mean, we've been hearing, a lot of anecdotal stories where people were just shocked yesterday, like the impact it's going to have on people's loans, with variable rate loans and stuff like that. But again, just for everyone to understand, that was a unbelievable rate increase yesterday. Nobody was expecting it. If anyone says, oh yeah, they're expecting 100 basis points, it just means they're not informed. They're not informed with what the market is pricing in, where guidance has been, because markets don't work that way. They don't work with guessing. But that's my first thought for you, Steve. And
yeah,
Rich.
I mean, I think it's kind of important to highlight it. Just like I feel just like how all over the place and perhaps how wrong these guys have been over the last several years. Obviously getting inflationary, not wrong, but like disgracefully wrong. But I mean, like, was it the move in January where, like, I can't remember if it was January or February, where it was, the move was already priced in and they didn't raise rates.
Yep.
And like, and so
that was the first Twinkie bet.
That was the first.
It was my Twinkie. I had to eat the Twinkie for that one.
Yeah, these guys have just been kind of all over the place from the get-go. And definitely, Keith, to your point, if you do look at the Bank of Canada's verbiage after that rate hike, there was a lot of verbiage about pulling forward their moves and their rate hikes. So, I mean, that's something that for our listeners to kind of take in, that, a lot of this, I think, is just pulling forward some of those hikes. And watching an interview a couple of weeks ago with Stephen Pullos, it was kind of off the record. He was chatting about that too, is that they had to get very aggressive and get it in right away. So I don't know, Rich, if you have any additional commentary as well from your side.
No, not too much more. I think we owe Scotiabank an apology. I think we made fun of them quite a bit for their 8 rate hikes. So I think, I'll take that one. I'll take that one. I'll eat that one. I'm happy to be wrong. I'm guilty of it too. I mocked them, and it turns out they're probably going to be closer to right than we were. I think this is a function of lost credibility, and why a central bank must be not only independent, but to be perceived as independent. We've discussed that several months ago. And why I bring that up is because, the central bank was derelict in its duty in 2 ways. One, it not only got the inflation call spectacularly wrong, but also the length of the inflation. So the transitory, non-transitory debate, I think was just an out and out lie. But, that's a different conversation for a different day. Where they lost credibility was basically absorbing 90% of the federal government bond issuance in order to keep interest rates low. That was, to my view, a quantitative easing mistake that I think we'll be paying for a long time. And then, so when they didn't raise rates, last year, which I think a lot of people are saying, there was some question, the perception of their independence started to sort of fade away. And I think that's what we're seeing now. We're seeing sort of why it's so important that central banks sort of fight their urge to do the quote unquote right thing. And that's why they're unelected technocrats. This is why they're not affiliated to parties. So that when things get tough, they can sort of float above the machinations of different political wills and what your buddy from the Laurentians may or may not want to do with interest rates. And why I think it's, in a sense, a good thing that they're raising interest rates quite a bit. It's also just a function, let's remember, of them trying to regain that sort of credibility as this independent technocratic institution. And I think that's why it's sort of we live in interesting times. And that's sort of, for me, that was the real takeaway from that. And then the other thing that I think is important to remember is that the interest rate's still deeply, deeply negative, which is amazing, right? You mentioned how it's the fastest rate hike cycle in X amount of months. depending on what you use as your inflation measure. Let's just use sort of the core inflation based, one of their preferred core measures. Their preferred core measure is 4%, and so that means interest rates are still negative in real terms, which is,
let's be honest, though,
amazing.
inflation, like even at CPI, let's just say 8 is
sure,
even maybe a bit on the light side. So you got inflation at 8, and you got the rate at, what are we at now, 2.5?
Yeah, I was just trying to be conservative and choosing sort of the lower inflation rate. Just again, trying to be generous, I guess, in my analysis. But that the point remains that interest rates are still negative, which is quite fascinating. That after all of this, imagine all the damage that's been done as well in the markets. And Keith will obviously touch on that later. But markets are down 30%. House prices are starting to weaken, which we'll get into, and all that. And interest rates are still historically quite negative in real terms, which I think is kind of an interesting wrinkle to this whole story.
Yeah, no, I always like to go back and circle back. I think everybody's ultimately responsible for their own financial decisions. Getting back on Scotia's comment, kudos to them. I think that one thing I will say, we've talked about it on the show before, is that they're also calling for, just a moderation in housing sales and no decline in national house prices. And again, I don't know if you call a 20-year low in Canada's largest metropolitan city a moderation, but that was kind of always to my point, right? I just feel like central banks, given the level of aid that they've been providing markets over the last 10, 15 years, they're basically operating a switch, right? It's markets on, markets off, and I think that's what we're seeing now playing out. Is in the the Canadian housing market. I think the lights are turned off, and so we'll find out the repercussions of that, I think, over the next 12 months. But I think one thing I'd like to point out too, which is the importance here. So we've talked about this before. We'll kind of touch on the Canadian mortgage side, and then we'll shift gears, obviously, to our other macro viewpoint. But obviously, it's a Canadian show, so I want to touch on this because this is extremely important, I think, for the vast majority of Canadians. So you've got your fixed rate mortgage and your variable rate mortgage. With the Bank of Canada raising rates 100 basis points yesterday, instantly your variable rate mortgages were repriced by 100 basis points, so a full 1% higher. So before the announcement, your typical variable rate mortgage, give or take on a 5-year, was about 3.2%. And so now you automatically go to 4.2%. And so what happens then is that you had a huge chunk of home buyers in the market over the last year, basically. Actually, over 55% of new originations have been going variable, because basically there's been this historically wide spread where variable rate mortgages have been more than 150 basis points cheaper than your fixed rate. So everyone's like, well, why would I go with fixed? Variable is 150, 200 basis points cheaper. Let's go with the variable rate. And then because that mortgage stress test, when your fixed mortgage rate went to 5%, it means you had to get stress tested at 2% above that rate. So 7%, which means you lost all this borrowing capacity. So people were opting to stick with that 3.2 variable in recent months in particular. And so they're only being stress tested at the minimum qualifying rate, which is 5.25%. And so they weren't really losing any purchasing power. Yeah, you had to pay a higher interest rate, but you weren't really losing any purchasing power. Well, now that your variable is 4.2, it means you get stress tested at 6.2, which means you just lost basically 10% of borrowing capacity overnight. So basically anyone that was still active in the market, we saw a lot of people going to variable because everyone's like, well, I don't want to lock in a fixed at 5.2%. And so now that's going to hit home buyer demand even further. So again, now if the Bank of Canada continues to raise rates, like everyone's predicting, right? They're calling for more hikes in September. They're calling for an overnight rate to go from 2.5 today to 3.5 by the end of the year. So if we get to 3.5%, or I think it was 3.75 actually, is now what they're projecting. So that'll be 350 basis points of rate hikes in one single year. The typical variable rate mortgage in Canada is what's called a fixed payment mortgage. So yes, you have a floating variable, but your payment always stays the same. And what happens is when the rates go up again, you pay less towards principal and more towards the interest. But at some point, you become basically negative amortizing. You're not paying enough principal down. And so basically what happens is they have a trigger rate. That trigger rate is typically 350 basis points higher than your original contract rate. So if we get 350 basis point increase this year, you're going to have a lot of variable rate mortgages that get triggered. So they will basically, what happens when I say triggered, it means the bank comes, knocks on your door and says, hey, you need to increase your monthly payments. You're not paying enough of your principal down. And so depending on your mortgage size, it could be a couple $100. I don't really necessarily know the math on the top of my head here, but I think that's a very, very important story. And
so just for us layman's here. So basically the amount of interest rate hikes has been such that it is very, very easy to see a big, like a chunk of Canadian mortgage borrowers getting triggered, as you say, and having their total mortgage payment move or ratchet up a sizable chunk.
Yeah, correct. There's a lot of all the variable mortgages that are outstanding by Canadians, about 80% of them are what's called fixed mortgage payments. So they're variables with fixed payment structures. So I don't know the percentage off the top of my head of like how many Canadians have fixed versus variable. I think variable is definitely the minority share. I think it's maybe 35% as far I'm guessing here. But of those 35%, let's say 80% of them have fixed payment structures. So it's just another thing to kind of keep in mind as we move forward here, that like if that actually triggers and if we fully do get those 350 basis points this year, I think that's going to just be less disposable income for Canadians to spend. I think it just puts more strain on a highly levered private sector. So I think that, my view ultimately is I still don't think the Bank of Canada is going to get 350 basis points in this year. But that's something to sort of keep in mind.
Thanks for sharing that. And I do know that I don't think we're allowed to say names of specific banks, but one of the banks, a lot of their variable rate mortgages are not fixed pay. I think they are, what would you call that? A floating pay,
floating,
right?
Yeah, floating variable.
Yeah. So one of the guys I know, that's for his mortgages. And so about a year ago, he entered the market. And so his payment obviously his payment is going up all the time now. And it's a pretty significant increase in payment. So it's one thing for you as a borrower, if you know you're paying, what's an average mortgage payment for some people? $2,000 a month, $1,000.
Gosh, I just feel like it so depends on like when you purchase. I mean, people that bought like 15 years ago, right? I mean, you probably got a really small mortgage, but I mean, today, you know, typical home price in Vancouver is north of $1 million. So I mean,
yeah,
800,000.
I know some families in Toronto, like they're probably paying like $3,000 to $4,000 a month, right? That's what they're
okay.
They're
So
paying.
I would say like anyone, any young family that lives in Vancouver or Toronto, that's like, you know, late 30s, early 40s, it's got like a couple young kids and they've probably got like a townhouse or a single family home. Like I can almost guarantee that most of those people have mortgages of $1 million or more.
Mm-hmm. Yeah. So I think you're seeing a pretty significant increase in mortgage, cash flow coming out of people. And so I want to comment on two things, maybe three things, and I'm getting hungry as well. So I'm going to squeeze that in afterwards. Hey, I'm Boomer. I like a little, something sweet in the afternoon to keep me awake. First of all, one thing that we've introduced for a while now, and it would seem, a bit crazy at first. And I think now it's actually becoming more real. I continue to believe that not only are we headed for recession around the world, and it could be a dramatic one in specific economies, the central banks are trying to specifically drive it because that's the only way they can try to get inflation data to come down. The central banks, they cannot produce more oil or more gasoline, increase the yield on crops or anything all they can do is try to decrease aggregate demand. And the way you do that is with the recession. And you know what, if people get, their incomes go down or they lose jobs, some folks get hurt, that's what one of the big boys said a few years ago. I do think that's where we're headed. We also introduced the idea a few shows ago to start to watch what the banks are doing and saying. So for us here at our firm this morning was a pretty big announcement came up from JP Morgan. Now, obviously they're a big global bank, they're Americans and all that, but they miss on earnings. That's not a big deal because earnings numbers by banks can be manipulated to whatever number they want it to be. But what they did do was two things. One, they dramatically increased their provisioning for bad loans. So which means either they didn't have enough set aside to start with, or their expectation for the economy to be slowing significantly going forward is a lot more than they thought last quarter. Also recall that last quarter, Jamie Dimon, he's the CEO over at JP Morgan, he had an interview, and what was the words he described? We have a hurricane coming, an economic hurricane, or do you remember that, guys? Remember
I remember that.
And at the time, people were saying, you only like these guys when they say something that you agree with. If they say something you disagree with, they're an idiot. Anyway, he's gone from being an idiot to, more of a realist. What I suspect will happen here in Canada now, starting in August, when our big banks are coming out with earnings, I think you're going to see loan provisioning go up. Oh, the other thing JP Morgan did, they stopped their stock buybacks, which is pretty significant. So, in the capital markets world, instead of increasing dividend payments, stuff like that, from a tax perspective, you reduce the shares outstanding and everything. So for them to stop share buybacks and increase loan provisioning, that's like a wow moment. And that's in the strongest growing economy in the world right now. It's the core, it's the center of the earth. And so again, reaching out beyond the core to the next level where we are here in Canada, I suspect the Canadian banks will be increasing their loan provisioning next quarter, and specifically RBC. I can say their name because during their last earnings release, which is public knowledge, is data that's available for everyone, they actually took a negative charge on their loan provisioning. So which means they clawed back, from their rainy day fund, so to speak. I do not suspect any Canadian bank they're at the position right now where they're going to either stop buybacks, and the very last thing a Canadian bank will ever do will be to cut their dividend. So we're not at that point right now. However, things are winding up pretty tightly outside of Canada, that if things do deteriorate, we could get that moment here in Canada, which will make it even more interesting, which then will get reflected more with interest rates, credit spreads, as well as the Canadian dollar, which we know is not doing well. Reminder for everyone, we record this on Thursdays and we release on Fridays. But here on Thursday, there's a lot of red on the screen today, specifically in the currency market. I need to eat something while you guys.
Well, I just want to ask a question.
Rich, okay, go ahead.
Oh, sorry. Just a really quick question. It's just sort of both of you guys, actually. But so, I've come around to the view that the central banks are trying to hurt aggregate demand. I was probably late to that party. But my question is, do you think in Canada, they're trying to crash the housing bubble? Just like, do you think that's, it's related, it's different and yet related. Yes.
What's this for a screenshot? If anyone,
it's a good screenshot. Video. Should we do that?
Like this is everything. We got the Loonie Hour mug. We got Mickey, and then we got like Boomer here in the middle. This is an awesome day, guys. There we go.
All right, forgive me. An answer for a question, but so let me re-ask my question just because we got distracted by the Boomer eating a Twinkie. But the question is, Keith laid the case out for affecting demand as the only way to really bring down inflation. And I was just wondering, do you think that the Bank of Canada has its eyes on the housing bubble when it raises interest rates by 1%, when it's committed to more? Because, I'm of the view that, they're not going to be able to tackle inflation that way, but that's a conversation maybe for later on. But so what do you think, Steve? Do you think that the knives are out, that they're just trying to knock it down?
Yeah, I actually love this question because I like it's like thing is like when you post content like publicly, it's all out there. Like I remember talking about it on Twitter, you know, I think about a year ago, maybe like maybe even longer, but it was like I think it was late spring, early summer when the housing market was just going bananas, and the Bank of Canada was like, "No, we're keeping rates at zero. Inflation's transitory. Housing is just pent up demand." I was like, "These guys have to be utterly blind. Like this is not pent up demand. Like this thing is completely out of control." And they just kept pumping and ignoring it. And I was like, I actually thought that they were doing something similar to maybe like Japan, which was like basically trying to engineer like a bubble. So there's a lot of like one of my favorite books was Princess of the Yen by Richard Werner. He was actually the economist who coined the phrase quantitative easing. So yeah, he's also put together basically he basically wrote the book on the Japanese bubble, and his view was that policymakers were basically engineering and intentionally basically created a housing bubble. They basically wanted a change in government and government policy, and so they specifically engineered a bubble that burst and ultimately has never come back, 25, 30 years later. So that was my initial view. I was like, there's no way these guys can be that stupid. And so I don't know, like, are we going down at the same path where like, okay, they built this thing up to these insane levels and now they're hiking rates, they went from, hey, we're not raising rates till the end of 2023. Everybody go borrow your brains out. We will hold rates. And they blew this massive housing bubble. And then, they're going to jack rates 300 plus basis points by the end of 2022. So I just think it's the ultimate rug pull. I don't know if I want to say it's malintent, but something is a little bit fishy, and so I don't know. Is it I think societally, I think everyone knows our house prices are out of control. Maybe there's like this conspiracy of like the Great Reset. I don't know. I think that's I don't know if they're that smart, to be honest, but I also am skeptical that they can be this stupid either.
Keith?
I just think it's collateral damage. I mean, so when they're sitting there, they're trying to figure out what policy should be. Absolutely, the housing market is going to come up. Bank loan portfolios is coming up. They're getting feedback from the banks every single day, and then from the big infrastructure players and everything. And then they're chatting with the Americans and the Europeans and the Japanese and everyone else. I just, we've said this before. I think we really need to reset for everyone where we are right now in the world sort of economic theory. It's at the end of the 75-year cycle. So Keynesian economics, it's over. It's done with. They're by they, I mean the central banks as well as fiscal policy makers, that they're desperately trying to not have it end. They're trying to extend it. They've been trying to do that now for 15 plus years, and it has not worked whatsoever. And at the same time, well, everyone has been now synchronized with, weakening economies, extreme fiscal positions, extreme monetary, extreme inflation, extreme everything in the world. That's why we're getting pushed around here. So no, I don't think they're saying, yeah, we need to crush the housing market and get everyone. It was with the now Steve's having a Twinkie, which is great. Make a noise so we can see on screen.
I don't think you want to hear that.
But is it a Pepsi commercial? It was about the 1984 George Orwell book. Remember the guy had the hammer or I think the lady, and she ran in and crushed the big gong with it. You guys don't.
I wasn't even born.
I've read the book. I've read almost all
this
of
was
George
TV,
Orwell's books.
Television, not Netflix and things
black
like that.
and white TV.
Again, I don't think, I do think we are going to have something break and go like that, but I think there's a lot other movements happening that will, it'll just make financial markets, as collateral damage, and that's the housing market. Right. So that doesn't mean that they don't care about it and stuff like that, because obviously they do. But my view is that, the Americans, like, they're up now for 75 basis points for their next meeting, which I think is next? When are they up? When are the Americans up?
I was listening to Waller's speech this morning, by the way. Fed one of the Fed guys there. So he basically, I literally caught like a couple minutes of it, but it was like, he basically just said, hey, listen, like I'm voting for 75 basis points. We don't need to do more. So I think that is do well. But he also mentioned front loading as well.
So they're the 27th. So they're 2 weeks coming up. They're expected to do 75. And now you're starting to hear. I was chatting with a guy this morning who's pretty connected in our world, and he said, "Hey, Keith, like there's whispers of 100 coming up." I'm also hearing narratives that the Americans, led by Yellen on the Treasury side, they want the dollar just to scream higher. It's their incentive to. These are the words that were shared to me, that they have an incentive to crush some specific economies and systems out there, so you can take that for what you think, who and where they might be. And so it's our view that we're continuing.
Can you unpack that a bit further? Come on, don't tease us.
Yeah. So again, like today, everything's been wound so tight together that now you have geopolitics overlaid on top of call it financial politics if you want. But like one of the biggest weapons in the world today, it's it's the US dollar. So I mean, if you move outside the whole kinetic war space, which is they have what they have, people are now starting to appreciate it and understand within the US that just by tightening the US dollar even more, that gives them the opportunity to really tie the screws on your adversary. And the Americans have two big ones right now, and the biggest one it is China. That's what they were more worried about right now, despite all the other news that we see. And so what's happening in China? I saw a pretty good research note, actually by your new good friend Michael Nicolettos. I know you interviewed Michael there a few days ago.
Smart guy.
Yeah, really nice guy as well. And so Michael just sent me some of his views on what's happening over in China. And what he was showing was that, and demonstrating, is that the Chinese property market, it's just simply dwarfs of what the Americans had back before it crashed back in 08 and 09. It dwarfed what was happening in Iceland and Ireland and all these things. And they have this, what you call it's a closed capital account. So you can't get money in or out without someone opening the gate for you with the buzzer and all that stuff. And so the meantime, I think people may have already seen that over the last week, there's now quite a few lads over there in China are unable to withdraw their money out of their banks. So there's a lot of protest happening on that side. But with the Americans raising rates another 75 basis points in a couple of weeks, and if they do it again, then in September, that's when they're lined up with the Canadians again. There's a real opportunity for things to go off the rails, not only in China, but in the whole emerging market world. So remember the Silence of the Lambs story, which you still need to watch it, by the way, to figure it out.
I have watched it.
Jay, just to reiterate Michael's comments here, just so you guys are kept in the loop here. So in the past year in China, 28 of the top 100 developers, not small developers, but 28 of the top 100 developers have defaulted or asked their debt holders for extensions. They account for about 20% of China's total property sales. And in Q1, property sales fell 72% from a year ago, further eroding their cash flows. So basically, they're not able to. A lot of them aren't being able to finish construction of their towers that they've basically sold to a lot of these Chinese citizens, and the citizens are now kind of in revolt and refusing to also pay. Their payments, because I guess in China they make payments even though it's not constructed.
I just wanted to just add a little bit of context to what I think maybe some of our listeners may or may not know, that China pegs their currency, the renminbi, to the US dollar. And we've mentioned my favorite pickup line before, the impossible trinity, and it relates to that. So, I mean, what the US is doing by raising rates and letting the dollar rise, ultimately, to me, where the release valve, and there is always a release valve in financial markets, the release valve is that Chinese currency will have to depreciate. they cannot, and I don't know, Keith, if maybe you disagree, but they cannot keep this sort of link as tight as it is for a long time. And I mean, it's not clear that they want that, because I think China obviously doesn't want inflation. I mean, that's for political reasons more than economic reasons. But the other thing that's really important to note is that China's trade-weighted currency, obviously, trade-weighted currency is connected very much to the US dollar, but it's just in general, relative to all of its trading partners, is basically at an all-time high. So to me, that's where you're really going to see sort of the pressure. They need to release that pressure, and I think it's going to be in a lower renminbi. Ultimately, they have a lot of power and a lot of sort of dry powder to fight that. Remember, Keith and I have disagreed about this before, but I was definitely right. China has $3.2 trillion in reserves, and you're already starting to see their holdings of treasury starting to slink lower and lower and lower. And that's as they sort of fight to keep their currency pegged to the US. But I don't think it's going to last very much longer. Keith, do you have a view on that?
Well, first of all, you're wrong. They have $3 trillion in US dollar reserves, but US dollar valued reserves. They have $1 trillion in treasuries. The other $2 trillion. No, it is. The other $2 trillion is in assets valued into dollars. So there is a big difference with it. But the other thing that's really affecting China right now is what is happening in Japan. So with the yen now basically plummeting to new all-time lows, well, all for 138,
25 year, yeah.
Yeah, it's pretty low. The Chinese do not like this because that takes market share. It also puts pressure on other Southeast Asian markets, similar to the ones that had a lot of trouble back in 98. So with what's happening so you got the Japanese currency is extremely weak. That's because they can't let the bond market go in Japan. You got the Americans raising rates at 75 basis points. The Canadians doing 100 to try to keep up with the Americans. The Americans are doing now aggressive quantitative tightening as well. China has to import a ton of stuff to eat. They have to import a ton of stuff to burn. They're in a real tight spot here coming up, and all that has to happen. The Americans, so both the Fed and the Treasury, just have to make a decision to slack off on driving the dollar higher. If they did that, the world will exhale a little bit. The Canadians won't have to raise rates anymore. We haven't talked about Europe, of course. I love Europe. You know that. They may not be in as difficult spot. And as a reminder, we are Canadian centric, of course. And I know we do talk about what's happening outside of Canada a lot, but that's simply because that's where the game is, and everything that's happening outside of Canada will ultimately come back inside and affect Canada. So with the Bank of Canada hiking by 100 basis points yesterday, you might think, oh yeah, it's because inflation is high in Canada and stuff. It's because it's around the world. The Fed is doing it as well and all that. Before we jump over to Europe, did you guys want to talk any more about Twinkies or anything else?
Well, there's just one more thing I wanted to add related to the Chinese and the US dollar. And so there was some big news out this week. I know we're going to sort of do around the horn news a little later, but I just thought it was important related to your point, Keith, which is, so you guys might be familiar with something called the BRICS. It's a sort of an acronym for Brazil, Russia, India, China, and South Africa. This is sort of basically been expanded to make up to mean sort of emerging market countries that sort of are trying to align their interests, mostly economically. I think as things progress, it'll be more politically and militarily, but ultimately it was sort of about that. And you'll notice that, and then in general, two of those countries are sort of commodity exporters, and two of those countries are commodity importers. Importers being India and China. And what they wanted, and so the issue really China has is that the US dollar continues to be the foreign exchange reserve currency of the world. And one way that the Chinese, and to a lesser degree the Indians, sort of feel that they can deal with a lot of their economic problems and then ultimately political problems is sort of extract themselves from that dollar payment sphere of influence. Remember, dollars are used to settle lots of financial instruments and lots of financial, but also the vast majority of commodity and manufacturing and service trades are settled in US dollars. And so one way that these countries feel they can sort of extract themselves from that sphere, and then all of the sort of the effects and negative side effects and positive side effects from that, is to sort of create their own currency block. They had a meeting this week. There will definitely be more of those meetings. A lot of people always talk about, the different reserve currencies. Portuguese currency was a reserve currency. Then it was Spain. Then it was the French currency. And then it was the UK. And then ultimately, at the end of World War I, it became the US dollar that took over as the reserve currency of the world. And, a lot of my clients always ask me, Richard, what do you think about the US's status as the reserve currency in the world? And I always say, unless there's sort of a war, a hot war, a revolution, or a viable alternative, I don't think the reserve currency status is going to change for the US. But anyway, sorry, that's just the sort of why China and Iran and Russia and all these countries are meeting, because they sort of want to pull themselves away. And we've seen how much financial damage the US can extract on its enemies if it wants to. Anyways, there you go. That was it. We were happy to move on.
No, I just think that it's a good point. I just, as we can see, this is showing up, I think, in a lot of part of, the financial stress is showing up in currency markets, right? And inflation and a lot of these central banks ultimately being trapped, right? In highly indebted sovereigns and indebted societies. They just, a lot of them aren't unfortunately having the ability to actually normalize policy, right? Keith, to your point, kudos to you. We had the EU's European Commissioner for the Economy out today saying the euro is showing strength, but the dollar is strengthening more. So I think we briefly touched parity there the other day. So was that the first time in 20 something years?
Yeah, I think it was. The whole parity thing, it's just a number, right? It's literally a line in the sand. So it doesn't. What's the difference between 100, plus a bit or minus a little bit? It doesn't mean anything. However, like this morning, for example, so euro currency in the spot market, like it's just dancing on the one, and we've been watching this very closely for a few days, and I kept saying to one of the guys, I said, hey, like as soon as this breaches one, like it's down to 99 extremely quickly. And we're joking like, well, why should that happen? It just happens. And so sure enough, this morning, it danced around and boom, it just dropped immediately. It's recovered a bit here right now. But the main problem now with Europe, I know last week, Richard did an exceptional job explaining to us, why the farmers are protesting over in Europe. In Italy yesterday and today. So Italian President Mario Draghi, who was former head of the ECB. Prior to that, he was he with the IMF as well at one point? I think
and Goldman Sachs.
And Goldman Sachs, of course, the octopus.
Just like our boy Mark Carney, future head of the Liberal Party.
Yeah, absolutely. Anyway, like he basically, he came out and said, hey, listen, Italy needs a bailout. We need assistance here of some sort. Which is kind of interesting because, Rich, you sent out I think I commented to you. Rich sends out so many great charts all the time. I don't have time to always comment to him. But when there's one that is even better than the rest of them, I'll say, Rich, this is a good one. And I think it was yesterday, the day before, I think, Rich, you sent out the one showing the Italian current account balance. Crazy. And now, so you can explain what happened with that. But basically right now, what's happening in the Eurozone, they can't, if they start raising rates or reduce the amount of QE, it means rates will rise, and that will affect banks and their regulatory capital and investment portfolios and stuff. But it's also going to affect what the Eurozone member states, such as Italy, what they have to pay when they borrow. And they're borrowing a ton of stuff all the time because Italy has the third largest debt load in the world behind the Japanese and the Americans. But anyway, yesterday, Draghi said, hey, we're going to need a bailout. And by the way, I'm resigning as president because even though I'm a yo-yo, all the rest, everyone here, they're all even bigger yo-yos, and in typical Italian politics. And I don't know it very much, but they can never agree on anything. So this will stumble along to yet another Italian moment. So that's why the euro currency specifically has been under a lot of pressure. And, it is going to bounce around and everything. But, again, we are, I wouldn't put Steve's money in the Eurozone right now. So,
God bless.
I know.
Can I add something to that?
Jump in.
So the funny thing about that Steve comment, the comment you made, Steve, about how the euro is actually strong against everybody else, that's just a demonstrable lie. And I will show this chart. There's something called a trade weighted index. So whenever we talk about currencies, it's always like Japanese versus the yen, the Canadian dollar versus the pound, or whatever it is. It's usually a pair. So in their infinite wisdom, lots of statisticians and central bankers have come up with these things called trade weighted currencies. And those trade weighted currencies can have a broad basket. So literally every single person that you do trade with, or a narrow basket, the most important trade partners. So if you're Canadian, you can probably figure out pretty quickly who's in our trade basket: the US, Mexico, maybe the Europe, a little bit of China, a little bit of Japan. Anyway, and if you look at the trade weighted euro, and Europe, make no mistake, despite all its misgivings, is a powerful exporter and trades with lots of different countries in the world. And its trade weighted euro is down like 20% too. So that's just totally bogus as far as a comment is concerned. It takes 5 minutes of internet Googling to figure that number out. I'll share the chart. But then as far as Italy is concerned, I made the point that last week that green policy is effectively becoming macro policy. And I think we can extend this even further and say green policy is now becoming central bank policy, in sort of a delicious irony, because I remember Christine Lagarde did not want to lend any money to gas companies and oil companies. So, I guess you get what you sort of pay for sometimes. But the chart that I think, there's a lot going wrong with Italy right now, but I think it's important to sort of contextualize it in the sense that up until the spike in natural gas, which, by the way, was not only foreseen, but they totally could have done something about it and ahead of time. You had an Italy that was actually had some really positive things going on for it. Industrial production, which for years was moribund, was actually going up. Credit, despite the fact that the government is extremely levered in Italy, households and non-financial corporations actually don't have that much debt. And credit growth is normally a sign of a healthy economy. So that was going up. Employment was okay. Inflation, which in Italy has been always really low and been a problem, they actually had some decent inflation. And the chart that I'll share basically shows that this final piece, is the trade balance. And so for Italy, for a long time, they had a very negative current account balance. And then they had the euro area crisis in 2011, 12, 13, 14. It went on for a long time. And then finally, you had a trade balance that was positive and contributing, quote unquote, cash into their economy, right? So you're getting some net exports, you're getting money coming in instead of money going out. So that's helping with a very indebted and unsustainable situation. But if you have a huge current account balance, you can sort of muddle your way through. And that's why it's just such a nasty thing that's going on with the trade balance right now. So basically, Italy's trade balance was positive. All of a sudden, natural gas prices spike. They have to import an incredible amount of natural gas from two places, Russia, and then, forgive me, I'm lumping all of Africa together because that's the series that I'm going to show you. And that just basically has destroyed what is almost like 8 or 9 years of, I would say, goodwill. We know how much Keith hates Italy, but there have been some positive things on the Italian front. And within almost 6 months, all of that got wiped away. And it's just a really kind of, and that's what the chart that Keith's referring to. We'll share it for our viewers. If you look on my Twitter, you guys can find it. But that's really the screwed up thing. But back to the ultimate point is that now this ECB is in a situation where they can't raise interest rates until natural gas prices fall, basically, because they're in a squeeze. They're getting squeezed internally, externally, and from the commodity market. I just think I'm laughing because otherwise I'd be crying. It's a very kind of sad situation. Go ahead, Keith.
Yeah. So I think Keith does not hate Italy.
Come on,
Right?
just teasing. I'm just teasing.
Yeah, okay, yeah. I always like to say, I'm always, investment focused, and you always like or dislike a market. There will come a time soon when you all of a sudden you hear me say, hey, what, we kind of like this market now. We'll go in because it's been priced correctly. But to be clear, and I know Steve, you might go over there at some point, maybe, but if you have a chance to go to Italy, my God, it's just it's everything is beautiful in Italy. The only thing that's ugly about Italy is the debt, and you can't see debt. So let's be clear. And if you go down to Naples, they make some great pizza pies down that way. And I think everyone knows I like a good pizza. So I do like.
Yeah,
Italy.
I mean, hey, at least the currency's helping me out here after
It's
blew
at
my
what is
brains
it,
out
an
in that
8 or
wedding.
10-year high now versus the euro.
Oh,
What
guys,
is the
one
Canadian
thing.
dollar?
Yeah, for Canadian dollar, by the way. So we're trading 76. Call it 76 cents here right now. If we get some kind of crisis event, some big lender goes under or experiences stress, something like that. Remember we had that with Home Capital Group a few years ago, and it was sort of yawned off. But if we get something like that over the next few weeks, we'll see a 6 handle coming up extremely quickly in the Canadian dollar. So that's, people might think, oh no, we'll never go back, below 70 again. But that's how tenuous things are right now here in Canada. So off you go. I think that's a good shocker. Everyone's hanging up the podcast and going out to buy US dollars, which helps my book because I'm talking the book, of course, right?
A couple other sorry. I mean, just to kind of go around the horn as we're getting close to the end of the show here, but a couple of kind of interesting things. And I know we don't talk too much about the crypto space on this podcast, but I think that's been a really interesting space. Some interesting developments. I think, as everybody know, they were kind of the first one to go during that liquidity crunch several months ago. But some of the largest players obviously blowing up here in recent months. So you had Three Arrows Capital, which is that massive hedge fund. Those guys they went bankrupt and they've apparently disappeared. So the authorities, I believe in Singapore, are trying to find them. They're gone. So that's number one. Celsius, which is one of the largest crypto sort of lenders or bank accounts or whatever you want to call them. They kind of geared towards like retail deposits. They just filed for Chapter 11 bankruptcy. And then you have BlockFi, which is another massive crypto lender as well, which has also basically received like a bailout from one of these large institutions as well. So yeah, tons happening in that space. I think that's kind of the initial. So I always find interesting about the crypto space is like unlike the rest of like finance is like there's no Fed put in the crypto space, right? Like the Fed and the central banks are just happy to let it go and blow up, and it kind of just like fixes itself. Whereas, if you had this kind of carnage, I think in the rest of the real financial world, they'd probably be to step in as lender of last resort. But there is no lender of last resort in the crypto space. So I don't know if you have any comments on that, Rich, Keith, but.
Well, that stopped falling. Bitcoin stopped falling. I think that's a good sign, right?
Do you think that, Keith? Do you think that? Because I'm looking at I know I was kind of asking some of my buddies today about this today. I was like, what do you think? Like, obviously, I still think there's probably one more flush, but it's interesting to see that the price movement in like Bitcoin and Ethereum, which are the two largest, they've really just basically been muddling along here over the last 2 months, despite kind of the rest of the markets kind of puking here. So it's like, is that like, I don't know, have they put in the bottom? Is there still one more flush when something else blows up in the system here? Or have they got rid of like all that excess leverage with some of the largest institutions in the crypto space already blowing up?
I mean, I think everyone knows from my perspective, I do not follow that market even remotely to say I'm close to it. I know, the main, the main players, what they're doing, things like that, but I can't add any insight. But I can offer insight, is I think to what your question you're asking is, from a global top-down multi-asset class perspective. And if you ignore what's underneath any market, like it doesn't matter if it's tech stocks or oil or Bitcoin, or, we'll have it with the US dollar at some point soon as well. Markets will always move from, nobody is even aware of it to everyone dislikes it to it goes to euphoria and steps off. For us, I have it in my sort of my buy list. I do want to buy it at some point, but, and again, this is just based on experience of other markets, nothing in terms of, Bitcoin specifically, but I'm suspecting it could have another flush coming up. It needs one more flush so that nobody's even talking about it anymore. And so again, that's my thought. Everyone would take that for what it is. Again, I know the FX markets extremely well, and I know everything very well. I'm that smart.
How are you looking at? How are you guys
but
looking
not
at
that space?
How are you guys looking at commodities right now? Because I think specifically, I think this is probably a function of like risk off. The U.S. dollar obviously screaming higher, but if we look at commodity markets, at least from a pricing perspective, from the peak, lumber off 58%, nickel down 54%, aluminum off 37%, natural gas down 31%, steel down 28%, wheat down 28%, lead down 23%, copper down 22%, soybeans 18%, corn 16%, cocoa, oil off 13%. Is this just an opinion of risk off? Were commodities completely overdone? I think structurally, it seems to me that we're going to be in a commodity bull market from a longer term perspective. But
first of all, I didn't know there were that many commodities, so that's
there you go.
Cool.
Loonie Hour. You learn something new every show.
We do. I know it's that's what's so fun about it. So our view, markets are transitioning now away from this, hyperinflation, strong inflationary environment, focus on supplies to, we're going to recession. I think the recession story it's starting to be reflected in markets. What that means, we'll get softness in the commodity space. And then for us, we would see that as an opportunity. So I don't think, oil production has the opportunity to increase dramatically. It's going to take a long time to do that. Same with some of these other commodities as well. So the short answer is, we're in a soft patch. It's in a gully because of the recession that's coming up. Gully. It's just a gully. Just a gully.
A lot of motivated sellers these days.
Yeah. People just want homes. That's all they want. But then after that, though, we should start to see returning the trend again.
Yeah, so I'd agree with that. So I'm not going to reiterate. I mean, you got my views on the supply constraints for both raw materials and industrial metals and stuff, and oil have been well documented on this program. So I'll stay out of that. One thing I have been looking at is gold. I know we don't really talk about gold here too much. I think gold is becoming less and less important financially as more and more people have an increasing part of their wealth in their houses. That's maybe a conversation for a different day, but gold does tend to track real interest rates pretty well, and real interest rates continue to rise higher and higher. And so something that I, sort of told my clients is to just sort of steer clear from gold until you get sort of retrenching in those real interest rates. Happy to share that chart on that. And so that's something I'm really looking at. As far as the things like lumber, I mean, there's a lot of wood out there, so lumber never really had a supply constraint. So, I mean, I can't speak to lumber. But another thing that we also look at is what commodities can tell us about sort of the global economic picture. Sort of just reiterating what Keith said, and something that I would suggest all of our listeners to look up is copper, otherwise known as Dr. Copper, and Dr. Copper continues to fall. Not all commodities are sort of created equal with respect to their indication on global economic activity. Copper is has been historically a really useful kind of indicator on where sentiment is going, and right now it's not good.
There you have it.
There you have it.
Well,
there's like a couple one things I just wanted to say. A totally off topic. I know we're wrapping up, but I just want to sneak this in. Did you guys see the James Webb Telescope pictures? I know this is nothing to do with the topic at hand, but I just thought it was the coolest thing ever. I'm a big space geek, and if you haven't looked at that, you have to, boys.
I don't know what you're talking about. So
it's a telescope. It's an infrared telescope that they put at Lagrange point 2, which is a place in Earth's orbit that's like, you can basically hold the satellite from moving around, basically. And they threw up this $10 billion infrared telescope that can take pictures of the Big Bang. I think it's amazing. I had to share it on the Loonie Hour. You guys are glazing over.
To the moon, baby.
And
you guys are not as impressed as I am.
Rich's pickup lines are something else.
To the moon.
It's amazing.
All right. On that note, we'll call it a day. Rich, I think you still owe us another Twinkie, buddy.
No. Okay. I'll do it.
Don't think we wouldn't.
I have nothing to wash it down with. This one is a mint chocolate Twinkie.
That sounds
not
disgusting.
Only that'll teach me to make bets about the Central Bank of Canada, which has refound its testicular fortitude after many, many moons in the wilderness. There you go. Cheers, everybody.
By the way, I think if anyone has a lined Twinkie, I think we should get a sponsorship here. We've been pumping these guys bags for a while.
This is so disgusting.
Well, we're not going to get a sponsor if we say it's disgusting. That's
right. This is great. I love Twinkies.
I personally find it to be a very nice afternoon pick me up.
Afternoon delight at the Ice Cap household.
Yeah, I don't know. I can't.
Twinkies are so nutritious and delicious. If you want to be a good investment
part of a
manager
healthy,
like
balanced
Keith,
diet,
you eat 4 Twinkies a day.
And look at me.
he just hit his max PR on his bench press. So, anyway.
So guys, this was episode 40. We have the big, half 100 coming up soon.
We'll probably do. We're working towards a live Q&A webinar, not webinar, but like a live Q&A, maybe like a YouTube stream where people can kind of come on, ask questions, build the community out here. So, we'll kind of keep you guys posted on that. But as always, we appreciate the ongoing support. All we ask that you share this with one friend or family member. Pick up your box of Twinkies, support your local Twinkie dealership, and we'll see you next week.
All right, see you, boy.